I think the impact of a Fed rate hike going into middle of 2015 and normalization, monetary normalization had an impact last year significantly given the reaction in terms of taper tantrums onto emerging market currencies. But we've seen some improvements in some of the emerging market economies in trying to allay some of these concerns, addressing some of the fiscal and also some of the using policy to address some of the current account deficits, improved sort of sentiment internally from a political environment. So we might see a less pronounced outflows like what we saw last year, middle of last year. But nonetheless, given normalization coming on stream into middle of 2015, we might see a bit of outflows concerns out of emerging market as in totality, but you might see some differing moves in terms of extent of outflows. And then thereafter, I think those with stronger fundamentals might pan out better than some that are still struggling to address some of those fundamental weaknesses that they have. In terms of liquidity, it also depends on the extent of their exposures in terms of credit. Some of them have exposures from a wholesale funding perspective, and also some from a household debt exposures. And also how the depth of the financial markets within those countries itself, how deep they are, how diversified they are from just relying on bank credit, as well into capital or financial markets like fixed income instruments in terms of borrowing. The rise in rates next year should have an impact specifically onto bank credit, and also if the business cycle turns out badly, there could be some impact if employment figures sort of worsen. But in general, those countries with imbalanced reliance towards more bank credit and less financial depth, with a rapid increase in interest rates, the domestic credit side of things might be a bit unstable, which leads to greater volatility and probably more capital outflows from those countries.